Okay, now let us actually look at some common terms and ratios or analysis that we do in case of convertible bonds. All right, there are some common terms or some common analysis and ratios that we do in case of a convertible bonds, and this is one of the most important areas that is tested in the CFA. All of what we did is slightly less testable, but it's actually a very good base that you need for understanding a convertible bonds valuation. But the most testable area from a CA final perspective is these ratios or these analysis. The first term is conversion ratio. Conversion ratio basically represents the number of shares that you expect to receive upon conversion. This was basically 20 in our example. For every bond, you actually get converted into 20 equity shares. So the number of shares that is going to be received upon conversion is 20, and that is referred to as conversion ratio. So conversion ratio is determined at the time of issuance of the convertible bond itself. When the company is issuing a convertible bond, at that time itself, the company basically states that what is the conversion ratio. Every bond is going to have a certain number of equity shares that are going to be received upon conversion, and that is determined at the time of issuance itself. All right, both the conversion date and the conversion ratio. Conversion date is something that we referred to earlier. Conversion date and conversion ratio, both of them are determined at the time of issuance itself. The next is convertible value, also referred to as conversion value or stock value of a bond. Convertible value or conversion value or stock value of the bond. The more frequent term used is conversion value, but it's also referred to as stock value of a bond. Now, if you look at conversion value or stock value, look at the nomenclature, stock value or conversion value, which means if you convert it into equity shares, what is the value that you're going to receive? If you convert it into equity shares, what is the value that you're going to receive? So it's basically going to be number of shares that you're going to receive upon conversion multiplied by the current market price per share. All right. What is the conversion value? Basically means if you convert it into equity shares, what is the value of this? All right. So the stock value of the bond or conversion value basically represents the number of shares that you're going to receive upon conversion multiplied by the market price per share. This in our example that we did was 20 shares multiplied by the current market price of rupees 4, which is 80. All right. 4 rupees was in case 1 multiplied by 20 shares is equal to 80 rupees. That is represented as the stock value of the bond or conversion value of the bond. This is also what we discussed as the market value of equity over here. What we refer to as market value of equity is nothing but the conversion value. All right. So what we actually discussed is the market value of a convertible bond will always be greater than the conversion value. The market value of a convertible bond will always be greater than the conversion value. Earlier when we were discussing, I used the terminology market value of convertible bond versus market value of equity. What is actually market value of equity is nothing but conversion value. Over there also what I told you is we compare one bond's market value with 20 shares market value. That 20 shares market value is only being referred to as conversion value. So the market value of a convertible bond will always be greater than its conversion value. Okay, now because I said that the market price of a convertible bond will always be greater than its conversion value, we calculate something called as conversion premium of a bond. The market value of a convertible bond will always be greater than the market value of equity or conversion value. Therefore, we calculate something called as conversion premium. Conversion premium is basically calculated as the market price of a bond less conversion value, the whole divided by conversion value. Let us say if your conversion value is 20 multiplied by 4, which is 80, and let us say if the market value of the convertible bond is 120. All right, hypothetically, let's assume the market value of a convertible bond is 120, conversion value is 80, then your premium is basically calculated as 120 less 80 divided by 80 itself. All right, the base on which you calculate premium is the conversion value. All right, so you're paying a premium of 40 for the convertible bond. You're paying a premium of of 40 rupees for the convertible bond, and on the base of 80, all right, what you're receiving is actually what you're calculating is on the base of equity, which is 80, and that is going to be 40 divided by 80 is basically 50 percentage. All right, this is expressed in percentage. If you just need the conversion premium of bond in rupees, then you do not divide it by conversion value. If you just need the conversion premium of bond in rupees, what you have to do is market price of the bond less conversion value. All right, so there are three ratios that we discussed. One is conversion ratio, the other is conversion value or stock value of the bond, and the third is conversion premium. Why are we calculating conversion premium? Because we always know that the market value of a convertible bond is going to be greater than the market value of equity or the conversion value. The market value of a convertible bond will always be greater than its conversion value, and hence we're calculating premium. Premium can be rupees or in percentage terms. Generally, it is going to be in percentage terms. If it is in percentage terms, you got to calculate the premium by dividing it by conversion value. If you only need to find the rupee, it's going to be equal to the numerator. The rupee terms of premium will actually just be equal to the numerator, and in percentage terms, you got to divide it by the conversion value. I'll just take a pause to check if you have any question.
So, market price of the bond is the current market price of the bond, and the conversion value of equity shares that we are taking is a future expected value of conversion that we are expected to receive.
No, for the purpose of this comparison, both of them are in today's terms itself. All right, like we are
Okay.
comparing the market price of a convertible bond today with the conversion value today. Like if you convert it into equity shares now, what is the value that you're going to receive?
Okay.
Okay, now let's move on to another term called conversion price upon issuance. What typically happens is entities will state that one bond will be convertible into 20 equity shares. Entity will actually state that one bond will be convertible into 20 equity shares at a point in time in future. What you can do is upon issue at the time of issuance of the bond itself, we can actually calculate the implicit conversion price. What is the implicit conversion price? Implicit conversion price is basically the price at which the convertible bond has been issued. The price at which the convertible bond has been issued, divided by the conversion ratio. All right. For example, conversion ratio is 20. Let us say I issued the bond at 100 rupees. Convertible bond, I issued it at 100 rupees. The conversion price will be 100 divided by 20, which is equal to rupees 5. 100 divided by 20, which is equal to 5. What does this 5 basically mean? It means that if the share price touches 5 rupees, then it is actually worth converting. If the share price touches 5, then it is worth converting because you paid 100 for a bond. And if the share price touches 5 rupees, then you're basically going to break even, right? You're actually going to receive 100 rupees worth of value. If it crosses 5, then you're at a gain. If it is below 5, then you do not opt for conversion. If it is equal to 5, then you're at break even, implying that if you purchased it at 100 rupees originally, you purchased the convertible bond at 100 originally, all right, and you are actually, if the market price is 5, then you are actually receiving value of 100 as well, and therefore you're at break even that way. All right, I'm using the break even more just for the sake of communicating, but basically you're at no gain or loss. If the market price of the share goes beyond 5, then you will be at a gain. If the market price is less than 5, then you actually do not convert it. Do not convert it and actually receive redemption value instead of converting it. So the conversion price upon issuance is something that the company generally does not state, but that is inferred using the conversion ratio. Conversion ratio is given as part of your offering documents or prospectus. Conversion price is something that we are calculating as issue price divided by conversion ratio. This is the conversion price upon issuance. All right, this is the conversion price upon issuance. All right. Similarly, you actually have conversion price at based on market value also. You have a conversion price based on market value, which is called the market conversion price. Because an investor who would have purchased the bond at the time of issuance, for him, this ratio is relevant. An investor who would have purchased the bond at the time of issuance, for him, this ratio is relevant, where he takes issue price divided by conversion ratio. But let us say if I am an investor who has purchased the bond not at the time of issuance, but I'm purchasing it from the market value today. I am purchasing the convertible bond from the market value today. So for me, the price that I'm going to pay is the market value of the bond. So if I want to calculate the conversion price based on my purchase price, if I want to calculate the conversion price based on the amount that I paid for the convertible bond, this is not going to be relevant for me. What is going to be relevant for me is the market conversion price, which is the current market price of the bond, the whole divided by conversion ratio. Current market price of the bond divided by conversion ratio. Remember, upon issuance, the bond was issued for 100, but after that, the market price of the bond was actually fluctuating. It was not constant at 100. Now, if I'm purchasing the bond, convertible bond from the market, then for me, the purchase price is not 100. It's going to be the current market price. Therefore, the conversion price for me should be calculated based on what I paid, and that is the reason it's going to be current market price divided by the conversion ratio. I actually mentioned conversion price upon issuance only for the sake of clarity. This is not there as part of your curriculum, at least. Yes, it is there outside CA final curriculum, but there is no question or anywhere where conversion price upon issuance has been calculated. But I've only put it down for the sake of clarity. What is actually going to be tested in the exam is the market conversion price. So you'll be given the market price of the convertible bond. You divide that by the conversion ratio to get the market conversion price. What does the market conversion price mean? It means that if the share price touches this value, you're going to be at no gain or loss. If it crosses that value, you will exercise conversion and you will be at a gain. If it is below this value, you will not exercise conversion and you will receive the redemption value. This market conversion price is also referred to as conversion parity price. Market conversion price is also referred to as conversion parity price. Alright, this market conversion price can be compared with the market price per share. This market conversion price can be compared with the market price per share. If the market price of equity share is exactly equal to the market conversion price, then you're at no gain or loss. If the market price of equity share is greater than the market conversion price, then you will exercise the option and you're going to be at a gain. If the market price of equity share is less than the market conversion price, then you do not exercise the conversion option and you actually receive the redemption value. All right, all of these I know are going to be theoretical. We'll actually understand more as we do some questions. There are two other ratios that are there. Let us probably actually come back to these ratios after we do a few questions so that I don't want it to be daunting for you. Let's now do question number 22. A convertible bond has a face value of rupees 1000 and is issued at 1350 with a coupon rate of 10.5%. So issue price was 1350 with a coupon of 10%. The conversion rate is 14 shares per bond. This is basically the conversion ratio. One bond receives 14 shares. The current market price of a bond and share is 1,475 and 80 respectively. All right. The bond's current market price is 1,475. It was issued at 1,350, but a few years have passed by and therefore the market price is not constant at 1,350. It's now 1,475. And the share price is equal to rupees 80. The market price of share is rupees 80. Now remember, you should not be doing a direct comparison of 1475 and 80. That is going to be an absurd comparison. If you rightly want to compare, it should be 1475 with 14 shares, with 14 shares of market value. You should be comparing the market value of one convertible bond with the market value of 14 shares. The question is, what is the premium over conversion value? First, let us actually find out what is the conversion value. Conversion value basically is also called as stock value of the bond. Focus on the terminology. Conversion value or stock value of the bond is if you convert it into equity shares, what is the value that you're going to receive? Can you tell me what is the conversion value?
Uh, 14 into 80, which will be 1120.
So conversion value is going to be 14 into 80, which is equal to 1120. All right. If you convert it into equity shares, you will receive 14 equity shares. Each share is worth 80 rupees. Therefore, the conversion value is 1120. All right. What is the market price of the bond?
Current market price of the bond is 1475.
1475. All right. We already know that the market price of a convertible bond should be greater than the market value of the equity. The market value of a convertible bond should be greater than its conversion value is what we already discussed. All right. By how much is it greater?
355.
So it's greater by 355. If you actually think of it, you are actually paying a premium of 355. You are actually paying a premium of 355 to buy a convertible bond. If you think of it, you could have gone to the market and you could have purchased 14 shares. You could have gone to the market and you could have actually purchased 14 shares. That would have costed you 1,120. Another option is you can actually buy a convertible bond and convert that bond into 14 equity shares. You have two options in front of you. One, go to the market and buy 14 shares. The cost is 1120. The other option is you go to the market and buy a convertible bond, and for buying a convertible bond you pay 1475, and then if you actually convert it into equity shares you end up with same 14 equity shares, but under this option you actually paid 1475 for getting 14 equity shares. I'm repeating myself. I know that I might be repeating it again, but for the sake of clarity, option one, you go to the market to buy 14 equity shares and you pay 1120. All right. At the end of the day, over here under option one, you actually have 14 shares with you with a cost of 1120. Option number two is you go to the market, you purchase one convertible bond and you pay 1475. And let us say if you opt for conversion, you actually receive 14 equity shares under this option also. But these 14 equity shares, you got it at a cost of 1475. Option 1, you actually had 14 equity shares at 1120. Option 2, you actually have 14 equity shares at 1475. Therefore, you actually paid a higher price under option 2. Why did you actually pay a higher price? Because the convertible bond had a better feature than equity share. Reason being, if the shares actually tanked in future, if the share price actually fell in future, you will not convert it. You will not convert it and you will receive a floor value which is equal to the redemption value. You will basically receive a minimum price which is equal to redemption value instead of converting it. Therefore, the convertible bond had like an implicit floor, or it had a guarantee sort of a feature. Therefore, you paid extra for this convertible bond of 355, and that is referred to as premium. This is referred to as the amount of premium that you're paying over the conversion value. Conversion value is 1120. You paid a premium of 355 rupees. The premium that you're paying is nothing but the cost of guarantee that you're receiving. If the share price falls also, you will still receive rupees 1000 at the end of the maturity, and you're paying this extra premium for that guarantee. For that floor is what you're actually paying extra for. All right, so the premium that you've paid is 355. This is the rupee value of premium. Can we actually calculate the percentage value of premium as well?
It will be 355, which is the premium, divided by uh, 1120.
Yeah, we'll have to divide it by the conversion value. All right. Your base is 1120, but you're paying 1475. So you're actually paying a premium of 355 on a base of 1120. All right. This is the value of equity or the conversion value. You're paying an excess amount and you have to calculate the percentage as a percentage of the base value, which is equal to 1120. I'm not sure what the answer is. Whatever the answer is, that is
31.69%.
21, is it?
31.69%.
31.69 percentage. That is the premium over conversion value. Quickly looking at the answer, the conversion ratio is 14. We have the conversion value as 1120. Market price is 1475. Therefore, you have 355 divided by 1120. That is equal to 31.7 percentage. Okay, although the question does not really require, can we also actually calculate what is the market conversion price? What is the market conversion price in this case? Remember, the formula for market conversion price is the bond price market value, the convertible bonds market value, the whole divided by conversion ratio. The market conversion price is the bond price market value, the whole divided by conversion ratio. All right. So can you tell me what is the market conversion price in this case?
So it will be current market price of the bond, which is 1475, divided by the conversion ratio, which is 14.
So can you tell me what the
So
value, what the amount is?
answer will be 105.34 36.
So it's 105 point, let us say 4, right? Which means What this 105.4 is indicating is if the share price, which is right now at 80, if the share price, which is right now at 80, touches 105.4, then you will be at no gain or no loss. All right, because you paid 1,475 to buy this bond. This 1,475 will fetch you 14 equity shares, which means you have implicitly paid 105.4 per share. You have bought a convertible bond at 1475. You have actually paid 105.4 per share implicitly. The current market price of the share is 80. So if this 80, if this market price, which is 80 right now, crosses 105.4, then you will actually be at a gain. All right, it is at that point that you will actually start enjoying a gain. If the market price is going to be less than 105.4, then you will actually not opt for conversion. If the market price is less than 105.4, you will actually not opt for conversion. All right, 105.4 is implicit cost that you have paid on a per share basis. 1475, you paid it for one bond. Using one bond, you're going to receive 14 equity shares. So on an implicit basis, you've paid 105.4. You compare that with the current market price. The current market price is below 105.4, but if it breaches 105.4, that is the point where you start making gains. If it is exactly equal to 105.4, you are at no gain or no loss. If it is below 105.4, you will not opt for equity conversion itself. You will basically not opt for equity conversion. All right, so the market conversion price is 105.4. Let us say this is the case for an investor who actually is purchasing the bond from the market. Let us say I am an investor who purchased the bond not from the market but at the time of issuance itself. I purchased the bond at the time of issuance. What is the price going to be for me? Is it going to be 1475 or is it going to be 1000?
1,000 if purchased at issuance.
After it, it's going to be 1,350. All right. The face value was 1,000, but at the time of issuance, it was issued at 1,350. All right. So for me, the price is actually 1,350. If I am an investor who purchased it upon issuance, the cost of the instrument is 1,350. So for me, if I am an investor who's actually purchasing it at the time of issuance, then the conversion price on issuance would have been 1,350, the whole divided by 14, which will be less than 100. This will be slightly less than 100. I'm not sure what the value is. That's still fine. All right. So conversion price upon issuance is 1,350, which is issue price divided by conversion price. The market conversion price is basically based on the current market value. The market conversion price is based on the current market value, the whole divided by the conversion ratio. Is that clear?
Yes.
Okay. Now, if you actually think of it, the current market price of equity share is rupees 80. The current market price is 80. What I'm implicitly paying on a per share basis is actually 105.4. What I'm actually paying on a per share basis is actually 105.4. By buying one convertible bond, I'm actually buying one equity share at 105.4. Where we calculated the premium as 355, that premium can also be calculated as 105.4 less 80, which is the premium that I'm paying on a per share basis multiplied by 14. All right. 105.4 is the premium, is the price that I'm paying on a per share basis. 80 is the current market price. Therefore, I've paid an excess of 25.4. I've paid an excess of 25.4, and the number of shares that I'm actually getting over here is 14. Therefore, this is also going to result the same 355. All right, it might not be exactly equal to 355, maybe because we have rounded it off over here, but otherwise it's going to be almost close to 355. Can you actually calculate this number and confirm if it's 355?
Yeah, it's the same.
So the premium can be calculated in two ways. One is what we are doing is first calculate the conversion value where you're basically taking number of shares multiplied by 80. It's obviously mathematics. What we are just doing is shifting things from RHS to LHS and showing that they can be calculated in different ways. All right. Under premium over conversion value, what we initially did is we multiplied 14 with 80 rupees and we had 1120. We had 1120 as the conversion value. 1475 is the market value and therefore the premium was 355. We then divided 355 with 1120 to get 31.69 percentage. An alternate way which I'm saying is implicit amount that you're paying on a per share basis is 105.4. How am I actually getting this? It's 1475 divided by 14. Market price of the bond divided by the conversion ratio, which is equal to 105.4. This is the implicit price I'm paying on a per share basis. The current market price is 80, but I'm paying 105.4 per share. I'm paying 105.4 per share. Therefore, the premium that I'm paying is 25.4. The premium I'm actually paying is 25.4. I am paying a premium of 25.4 for every share. So on a base of 80, this premium, if I calculate, will also be equal to 31.69 percentage. I'm paying an excess of 25.4 on a base of 80. I'm paying 25.4 on a base of 80. So this should also be equal to 31.69, which is same as what we calculated above. All right. The only difference is over here, we are calculating it for 14 shares. Over here, we are calculating it on a per share basis. All right. Can you just quickly do 25.4 divided by 80 and confirm whether it's 31.69 percentage?
31.75.
That's because we actually took 105.4 as rounded. Probably if we would have expanded it, then this would have been 25.39 or something, and it would have been 31.69 percentage exactly. All right. Two alternative ways, both of them are giving us the same result. In the first method, what we are doing is we are actually taking it for 14 shares. The numerator was premium for 14 shares. The denominator was the market value of 14 equity shares. Alternatively, I can take the premium on a per share basis and denominator will be the market value per share. How am I calculating the premium on a per share basis? I'm calculating the implicit price that we are paying. There's too much of red. Let me change the color. I'm calculating the implicit price that we are paying, which is equal to 105.4. On the actual market price is 80. Therefore, I'm paying a premium of 25.4 on a per share basis. All right, that 25.4 multiplied by 14 is also going to give you the 355 that we originally calculated. All right, it is actually just pure math. If you're finding it a little overwhelming, actually just take a moment. You'll actually see that all the calculations are actually the same. At one place, you're multiplying the per share number with 14 and then calculating the premium. At another place, instead of multiplying the per share with 14, what we are doing is we are dividing 1475 by 14 to calculate the implicit share price, and the implicit share price is being deducted with the current share price to arrive at the premium per share. All right, it's just pure mathematics. We are changing how we are calculating it, whether we are doing it on a per share basis or whether we are doing it for 14 shares. All right, just take a moment in case you're actually finding it a little overwhelming, but it's actually going to be very straightforward. We're also going to do a few more illustrations so that you're able to comprehend with the formula.